Hello. I had a question that came up about how do you estimate standard deviations and correlations and asking about how they affect the volatility for options. So I wanted to put together a quick video that took a look at this, and I decided to start with Netflix. I chose Netflix because it's a pretty commonly known company. It doesn't pay a dividend, so the Black-Scholes model should work fairly well for Netflix without any adjustments. And I did some quick analysis on Netflix, and I was taking a look at the April option. So, based on the April option, there are about 53 days until that option expires. So, 53 over 365 would be the time remaining. That's the fraction of a year. I took a look at the 365 strike option. At the time I looked this up, Netflix was trading for $368.70. Now, note this is during the trading day, so it's probably already changed, but that was the approximate price at the time I looked it up. The risk free rate is about 1.5, 1.55%, somewhere in there, and that's just the 3 month Treasury bill. Now, you can argue that, well, this really has closer to 2 months to expiration. It's probably not going to make that much of a difference in estimating volatility. So, what I'm doing at this point is estimating what's called implied volatility. It's basically backing out the volatility estimate that's built into that option price. And so, when I look at Netflix for this particular option, this is telling me that the current price of the call should be $25.15, and the current price of the put should be about $20.63. That is a volatility of 41% as kind of the implied volatility, what the markets are building in. Now, when I looked this up, the call was trading for about 25.60 and the put was trading for about $20.10. But you can see this is slightly underestimating the value of the call, slightly overestimating the value of the put, but it's probably a reasonable ballpark. So the markets are building in a volatility of about 41% on an annualized basis for the next approximately 2 months on Netflix stock. Now, note, if I used a different company, it would have different volatility because the volatility is tied to the underlying stock. So that gives me an idea of what the market is forecasting for Netflix's volatility. Now, another way to estimate the volatility for a company is to look at historical data. So here I've pulled up Yahoo Finance quote on Netflix. If I click over to this tab on historical data, it pulls up kind of the last year of data. I'm going to set that to weekly, but you could use daily or monthly. You have to make an adjustment to get it to an annualized basis either way, but I'm going to go with weekly on that. And once I choose weekly, I'm going to hit apply. Now, this is going to update for the last approximately 52 weeks of weekly data. Then I'm going to click this download data button. And it's going to pull up a spreadsheet with Netflix historical prices. Let me make this a little bit bigger so it's a little bit easier to see. And what I'm going to do is get rid of this volume column. And I'm going to replace that volume column with percent change. So what I'm going to do is calculate the percent change each week. Now note this starts with the first week, second week, and so on. And I'm going to use this adjusted close column. Now for Netflix, it's not going to matter because it's not paying dividends. But if you had a stock with dividends, this would adjust for dividends, it adjusts for stock splits. So the adjusted close is what you want to use to calculate the weekly return or monthly return or daily return, whatever you want to do. So I want to take the closing price for the week divided by the opening price for the week and subtract off 1. Notice that gives me the answer in a decimal format. I want to go ahead and change that to a percent. Oops, go ahead and change that to a percent. Now I'm going to increase the decimal a little bit. It doesn't really matter, but I'm just used to seeing things in 2 decimals, so that's what I set it for. And then I'm going to drag this down. And that gives me the weekly percentage change for Netflix. Now notice some weeks it's really small, negative 0.12%. Some weeks it's a big change. Here we've got almost a 16% change. Here we've got an almost 13% change. Some weeks it's down, other weeks it's up. But what I want to do is, now that I've got that past data, I can calculate the standard deviation. And it's not going to make a huge difference, but I typically use the sample. And let me get the standard deviation of this sample. That gives me 4.54%. Now note, that's the weekly standard deviation. I need to annualize that. In order to annualize that, there's 52 weeks in a year. So I take the square root of 52 times the weekly standard deviation. Again, I'm going to convert that to a percent. And that tells me that over the last year, Netflix has had a standard deviation of about 32.74%. I could also say, well, that's nice over the last year, but if I'm looking at an option over the next couple months, I'm probably more focused on what the volatility has been recently than what it was a long time ago. So I might just look at the last, say, 10 weeks. It's TDV.S. And now I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks. And it's still weekly data, so I can just drag that down. That gives me a standard deviation of 23.38%. Now, one thing you might be noticing is I now have 3 different estimates for the standard deviation of Netflix. One is from implied volatility, and that said it was about 41% was the standard deviation. Here we've got about 33%. Here we've got about 23%. That's a pretty big range of results. And the problem is, this is historical data. It tells me what the standard deviation has been. Ideally, what I want to know is what the standard deviation is going to be. And historical data doesn't tell me what it's going to be. It tells me what it has been. Those are 2 very different things. Now, if I'm trying to project what it's going to be, I might look at things like, when is the next earnings announcement? So let me go back here to Netflix, pull up summary, and I see their next earnings is going to be that week of April that the contract expires, sometime in there. So that might increase volatility. Also, as I'm typing this, you can see up here, there's a headline. Stocks tumble as coronavirus fears escalate. So as I'm recording this, the Dow is off 1,000 points, 3.5% drop. NASDAQ, S&P, Russell, all similar 3 to 4% decline. That indicates that volatility is picking up right now. And so whenever I'm trying to forecast, I'm trying to think what things could impact the volatility going forward. Things like earnings announcements are going to have a big impact. Things like volatility in the overall markets, are they higher or lower? Those are going to have a big impact. So all of those things are going to factor into my analysis when I'm trying to predict what the volatility would be. Now, if I wanted to estimate the correlation, I've got Netflix here. So what I would do is, maybe if I want the correlation with the S&P 500, I tend to just use the spider. That's the S&P 500 ETF trust. That you could also use something like the Vanguard Total Market Index or something. It's going to give you a very, very similar result. I go to historical data. Still have the last year. I want to make sure it's the same format, so weekly, apply. Once I do that, I hit download data. Open that up. And now I'm going to copy this adjusted close. Just copy that and paste it over into my other spreadsheet. And now I'm going to do the same thing I did here with my percent returns. Just copy those, paste them over. And now I have two sets of returns. They're matched up, so they're happening the same timeline. And now I can go ahead and calculate the correlation. So the correlation is CORREL, array 1, which is going to be the stock, and array 2, which is the market. Now notice you can do correlation with another stock as well. And once I have those, I see that the correlation between Netflix and the S&P 500 over the last year has been 0.55. Again, that doesn't mean that's what it will be going forward. It just tells me what it has been historically. Now, one of the things that I find interesting about finance and what makes it so challenging is the puzzle aspect. You're always trying to make projections and solve what you think is going to happen, and you're not going to be right. As a matter of fact, what I tell students whenever we're doing forecasts, assume you're going to be wrong, because that's the base case scenario. There's so many things that impact your forecast that you're not trying to be right. Instead, you're trying to move closer to right. You're trying to get in the right range more often. And so historical data can help, but again, you want to think, is there something changing in the relationship between Netflix and the S&P 500 or whatever else you want to correlate it to that's going to change that relationship going forward? Is it going to be higher or is it going to be lower, and why? You should be able to tell a convincing story that supports your argument for whether it's going to increase or decrease. So that gives you an idea of how to estimate volatility, how to estimate correlation, as well as some of the cautionary notes. Remember, anytime you forecast anything, you're not going to be right. It's part of the false precision issue. We get very precise answers here. If you look, it's not just 0.55, it's 0.554095. It's probably somewhere between 0.5 and 0.6 in a narrow range. Maybe a better estimate would be somewhere between 0.4 and 0.7 for a correlation. The problem is we increase the chance of having that correlation in the right range, the range becomes broader and less meaningful. So it's part of the trade-off. So I'm going to wrap up here and close up this video. Thank you.